G'day legends, welcome back to the channel where we track the shiny stuff. I am your host at Gold Jumper. Jump up and under, let's get into it, because the gold market has been absolutely mental over the last 72 hours. Today we are breaking down the wild price action between March 8th and March 10th, 2026. We will look at the technical indicators like the relative strength index and those crucial moving average crosses across all timeframes. Plus, we are diving into the Middle East conflict, the oil price explosion, and the macro moves from Australia to Japan. Just a quick reminder that this is for entertainment and education only, so please chat with a professional before risking your hard-earned cash. The big question for today is, have we finally established $5,000 as the permanent new floor for gold? Drop a comment below with your price targets, and while you are there, smash that like button and subscribe to join the crew. Let's kick things off with Sunday, March 8th, 2026, when the market opened with a massive gap up. Spot gold jumped 1.69% to reach $5,174 and 23 cents. This was a classic flight to safety as the Epic Fury military operation in the Middle East shifted into a higher gear. With traditional markets closed, digital gold, like Pax Gold or PAXG, surged 2.2% to 5,344. Over in India, the 24-carat rate hit 1.63 lakh per 10 grams, proving the global panic was very real. Traders were reacting to the effective closure of the Strait of Hormuz, which handles a fifth of the world's energy supply. Then came Manic Monday, March 9th, 2026, and things took a very strange turn for our precious metal. Global stock markets opened in a sea of red, with Japan's Nikkei 225 plunging 5.2%. In this environment, gold was used as an ATM, meaning investors sold their gold to cover margin calls on losing stocks. Spot gold dropped 3% to a low of $5,016 per ounce during the London session. But don't stress, because buyers stepped in at that psychological 5,000 level to pare half of those intraday losses. By lunchtime, gold had stabilized near $5,090 as the dash for cash started to ease up. Moving into Tuesday, March 10th, gold began to consolidate around the $5,130 mark. President Donald Trump helped calm the farm by describing the military operations as a short-term endeavor or a little excursion. This rhetorical shift eased the immediate war premium, even though the blockade at the Strait of Hormuz was still ongoing. Traders are now holding their breath for the upcoming US inflation data to see what the Federal Reserve does next. No dramas in the dip, just more room in the pouch, because the technical setup is still looking quite constructive. Now let's pull up the one-day chart and look at our technical indicators for the XAUUSD Forex pair. The Daily Relative Strength Index, or RSI, hit an extreme reading of 19.82 during the Monday liquidation. That is deep into oversold territory, which usually signals a healthy rebound is coming after a massive dash for cash. We also have a massive gap between the current price and the 200-day simple moving average at 3,969. The 50-day moving average is sitting at 4,814, providing a secondary layer of structural support. Most importantly, we have a confirmed golden cross on the daily chart as the 50-day average remains well above the 200-day. This indicates that despite the recent volatility, the long-term primary trend for gold remains aggressively bullish for the year. Dropping down to the 4-hour chart, the technical picture for the XAUUSD pair looks a bit more balanced. The 4-hour RSI is currently sitting at 66.82, which is strong, but not yet in the overbought zone. Price is trading in the upper half of the Bollinger Bands, or BOLL, confirming that the bulls are still in control. The middle Bollinger Band at $5,300 is the next major upside target for the short term. Meanwhile, the lower band at $5,100 is acting as immediate support during these minor pullbacks. The MACD signal is also positive at 57.7, showing sustained momentum even after the January peak. The parabolic SAR dots are still positioned below the price candles, which is a classic signal that the uptrend is intact. On the 1-hour chart, we can see gold has been fighting a short-term downtrend line near 5,139. Every time we test that 5,139 level, we see a bit of rejection from the sellers. Traders should watch the zone between $5,065 and $5,050 for intraday support. If we can break and hold above 5,141, the momentum could shift back to the bulls. It is a real tug of war right now, as the market weighs geopolitical fear against the need for immediate liquidity. Let's talk support and resistance levels, because these are the lines in the sand for every legend trading gold. $5,000 is the crucial psychological floor that the bulls have defended successfully over the last few days. Below that, we have major structural support at $4,842, our February cycle low. On the upside, resistance is tiered, starting with the minor supply zone between 5,185 and 5,200. A sustained break above $5,280 is the key to kickstarting a rally toward the old highs. The ultimate target for many institutional banks remains $6,000 an ounce by the end of 2026. Remember, we are still about $200 below the all-time high of 5,627. The geopolitical situation is the main engine driving this volatility, specifically the epic fury conflict in the Middle East. The Strait of Hormuz is currently seeing a 80% reduction in shipping traffic due to the ongoing missile strikes. Iran has officially confirmed the closure of the waterway, threatening any vessel that attempts to pass through the region. This isn't just a military story, it is an energy story, with 20% of global oil and gas now effectively stuck. We have seen force majeure declarations from Qatar Energy and Chevron, halting production at key facilities and gas fields. For gold, this creates a two-track boost: immediate safe haven demand and long-term inflation hedging as energy costs skyrocket globally. Iran has signaled that only Chinese vessels can transit, which adds a whole new layer of complexity to global trade relations. President Trump's rhetoric has been wild, warning he would hit Iran 20 times harder if they keep the strait blocked. But his later comments on Tuesday about a short-term excursion helped stop the absolute panic in the global markets. Let's pivot to the energy sector, because WTI crude oil had one of its wildest days in history on March 9th. WTI crude futures surged 18% on Monday morning to reach a year high of $119. That is a massive jump from the opening price of $100 and 20 cents per barrel. However, the gains didn't last, as prices plunged over 30% to touch $81 after G7 reserve rumors. WTI eventually settled around $94 and 77 cents, marking a massive $38 intraday swing. This oil volatility has a mixed impact on gold because it drives up inflation expectations but also pushes up bond yields. The 10-year US Treasury real yield rose 20 basis points to 4.128%, increasing gold's opportunity cost. This explains why gold fell on the same day oil spiked. Investors were pricing in higher for longer interest rates. Keep a close eye on the OVX, which is the CBOE Crude Oil Volatility Index, currently sitting near 103. An OVX reading above 100 signals extreme fear, which usually keeps the crisis premium in gold very high indeed. The US dollar index, or DXY, has also been a major headwind for our gold positions over the last 3 days. The DXY climbed to a 3-month high of 99.11 on Monday as investors rushed into the greenback. This is part of the petrodollar trade, where institutions need dollars to hedge against rising energy costs during the war. But with US inflation showing signs of cooling to 2.8%, the dollar's reign might be nearing a peak. If the DXY starts to soften, gold could easily reclaim that 5,400 to 5,600 range. Trump has said he is okay with a weaker dollar, which is music to the ears of gold bugs everywhere. Now let's look at the macroeconomic landscape, starting with some surprising news from Japan on March 10th. Japan's final fourth quarter GDP growth was revised upward from 0.1% to 0.3%. Strong winter bonuses and capital spending have pushed their core inflation to 2.5%, well above target. This means the Bank of Japan might actually hike rates soon, which could strengthen the yen and weaken the US dollar. A weaker dollar is a direct tailwind for gold prices, so keep an eye on those legends in Tokyo. Over in China, the National People's Congress is signaling a massive shift toward infrastructure and industrial stimulus. China remains the dominant force in the gold market, with their central bank leading the world in gold accumulation. They are diversifying away from US dollars at a record pace, providing a long-term support floor for the metal. Stimulus from the world's second-largest economy is always bullish for metals, as it boosts global demand and sentiment. Germany, however, is struggling, with factory orders plummeting 11.1% in January, the worst drop since 22. Their industrial production fell 0.5%, showing the high cost of energy is really hurting the European engine. This industrial setback in Europe adds to the global uncertainty, making gold look even better as an insurance policy. Let's bring it home to Australia, where the Reserve Bank of Australia, or RBA, is keeping us on our toes. Our local economy is expanding, but inflation is still sticky at 3.8%, which is a bit of a worry. The Westpac Consumer Confidence Index for March edged up 1.2% to 91.6. But here is the catch. Sentiment deteriorated massively during the survey week as the Middle East conflict intensified. Responses in the final 3 days of the survey were consistent with a reading of just 84, showing growing fear. Inflation expectations in Australia saw the largest weekly rise since 2010, jumping to 5.2%. RBA Governor Bullock has said the next rate decision on March 17th is live, so expect some volatility there. Some famous investors have been weighing in on this gold rally, and their comments are worth a listen, legends. Billionaire Ray Dalio warned that the surge in gold reflects a decline in the real value of fiat currencies like the dollar. He described gold as a standout event and a necessity for investors looking to protect their wealth from debt crises. Stanley Druckenmiller and Paul Tudor Jones are also bullish on gold as a store of value in an inflationary world. They are famously short on bonds, fearing that uncontrollable federal deficits will lead to obscene government spending. Jones believes inflating away the debt is the only way out, a scenario where gold is the ultimate winner. Major banks are also playing catch-up, with Goldman Sachs raising their gold price target to $5,400. JP Morgan is even more aggressive, projecting that spot gold could hit $6,300 by year-end. When the big money starts talking about 6,000 plus, you know we are in a historic bull market for precious metals. To summarize the main points, gold has successfully defended the $5,000 level during a massive liquidation event. The technical indicators are showing oversold conditions on the daily chart, suggesting a potential rebound is on the cards. Geopolitical risk from the Strait of Hormuz blockade is providing a massive war premium that isn't going away anytime soon. Oil prices are incredibly volatile, with WTI seeing record swings that are fueling global inflation fears and bond yield spikes. Central banks in the global south, led by China, are continuing to stack gold to diversify away from the US dollar. Macro signals are mixed, with Japan growing and Germany slowing, but Australia is bracing for more potential rate hikes. High-profile investors like Ray Dalio see gold as a mandatory hedge against the debasement of fiat currency. The golden cross on the daily chart confirms that the primary trend is still pointed firmly toward the moon. So traders, the big question remains, do you think gold can hit 6,000 before the end of the year? Are you buying this dip or waiting for more clarity on the Middle East situation and the Strait of Hormuz? Let us know your thoughts in the comments below, because we love hearing from the legends in this community. If you found this update helpful, please give us a thumbs up and share it with your fellow gold bugs. Don't forget to hit that subscribe button and turn on notifications so you never miss a market move. We have a lot more coverage coming your way as the US inflation data drops later this week. It is going to be a wild ride, so make sure your portfolio is protected and your risk is managed. No dramas in the dip, just more room in the pouch, as we say here at Gold Jumper. We will be back tomorrow with another deep dive into the technicals and the latest breaking news. Keep an eye on those technical levels we discussed, especially that 5,000 floor and the 5,200 resistance. The market is moving fast, so stay active and stay informed to make the best possible trades. Thanks for watching, legends, and for being part of the best gold tracking community on YouTube. Stay active, stay legendary. Catch ya.